Well, good morning, all. It's a great opportunity to be here with you today and have a dialogue on payments regulation or financial regulation, which I know has been a very important topic for the industry over really the past 3 years now, coming out of the financial crisis.
Quite some time. So Notch is the administrator of the ACH network. We are the rule-writing body. We enforce the rules and we manage risk on the network. But we are not the operators. So there are two ACH operators, the Federal Reserve Systems, the Retail Payments Office for the Federal Reserve Bank, and EPN. So it's a private sector ACH operator. So I think we're very unique from the card systems in that we have kind of bifurcated the switches and the rule-making authority is bifurcated. So when we're talking on our pre-call about regulation, what does it mean? I think one of the interesting things about the panel is we all come from a very different perspective. And as we've been caught up in the events of the past couple of years, looking at this from a network perspective, the issues that we've been looking at or trying to get our arms around are, what does this mean for, hello? Usually I'm blasting everybody out. So what does this mean for volume shifts? I know we're going to be talking today about the Durbin Amendment. What does that mean for volume shifts from, say, the card side, the debit card side, to ACH or back? Does it mean when we're looking at that, are parties more or less likely to innovate? While financial institutions may be more interested in innovation, will the merchant community be as interested in innovation now that they don't have the same incentives to try to find other payment methods? So I think that's something that we're looking at. What does it mean for efficiencies? So now that we have this kind of avalanche of regulation, and now that we have not just Durbin, but the whole, all of it. One of the things we're looking at is Title VIII. We've been looking at the NSFOD, the Card Act, all of this is avalanche of regulation. What does it mean for efficiencies? Will this help financial institutions to be able to leverage a network effect? So the things that the networks offer, when financial institutions are looking at creating efficiencies, will having bilateral contracts off to do different things, will having large correspondent banking networks around the world still be quite as attractive when you have to manage all of that? Or can you leverage the network effects out there and try to do things more efficiently and in a less costly fashion? So I think I'm pretty sure that Rich Oliver this afternoon, when he comes in from the Retail Payments Office, will be talking some about globalization and what it means that we've had the first ACH transactions come in from Europe, from Equins in Europe through Fed Global. So what does that mean for things? So I think that the efficiencies, leveraging network effects, innovation, I think that there's still a lot of opportunity out there. But one of the questions I have is yet another reg comes out or yet another change happens is a resource issue. And I think it's something we really have to grapple with because people are exhausted. And there are a lot of resources going into just staying on top of things, let alone trying to, look down through all of it to see how it ultimately, it's the spider's web or the pool where you throw a stone and you're trying to watch those, but so many stones are getting thrown in that pool. How do you see all those ripple effects and how they kind of overlap each other? So I think that that's part of our conversation today, and I know we'll be getting into a lot more detail about what certain regs might mean and how they might affect certain industries, but just from this network perspective, it's trying to work through all of those and get some understanding about what we think might be happening in the future.
Thank you, Jane. My name is Wayne Johnson, and I work with Raymond James, a brokerage house, and I'm a research analyst in the transaction processing sector. I've been covering the sector for quite a while, and it's never been more interesting than it is today. And you can take that both as positives and negatives from my standpoint, for sure. Essentially, what I try to do is link the big picture with the companies and how they operate in that big picture, and come up with some sort of recommendation, which I'm not going to do here today. What I am going to do, though, is talk more about the regulatory impact a little bit, and try to have an interactive dialogue with the audience and get feedback on where they think things are going and what the biggest challenges and opportunities may be. Crisis breeds opportunity. I'm a huge believer in that, no question about it. Somebody is going to win. Now, someone may lose, but someone will definitely win. And where I spend most of my time, just to give you a sense, are on some of the network guys, the Visas, the MasterCards of the world, the merchant acquirers, that would be the Global Payments, the Heartlands. And so my companies provide, and you guys provide, some part of the transaction process in the food chain of enabling an electronic payment to be completed, whether it's the retail point of sale or over the internet. In today's world of uncertainty, and there is uncertainty, in my opinion, anytime the government sticks their pen into that sector, which they have done, into financial technology in general and payments in particular, I don't know what the ultimate outcome is going to be in terms of, and I'm assuming everyone knows what the Durbin Amendment is, which is going to regulate debit interchange. And the government was not specific whether it was signature or PIN, so my assumption is it's both. What is the magnitude of that potential price decline for interchange? And we're guessing maybe it's 40% or so. And as Jane alluded to in her opening remarks, what does that mean for the networks? And is it an opportunity for ACH? And just quite frankly, Jane, ACH, I think, is phenomenal network, and it's dramatically underused. And so from a profitability standpoint, frictionless can still lead to high profits. High friction transaction costs ultimately will create innovation, and people will come under them, and we're seeing that. Having said all that, what does it mean? What do I think it means? Most of the networks that I've talked to have indicated they're going to offload these expenses, or they're going to be charging their customers, who are the banks, to implement many of the changes. Now, that hasn't happened yet. We don't know how it's happened, how it will, or I don't know how it will happen per se, but that's some of the feedback that I've received. If the Fed takes the full 9 months to issue an opinion in terms of what the debit interchange ultimately will be, I've heard a number of networks say that's not enough time to make the changes by July. I'm going to be broad here. I think the third week of July is when the president signed the bill. So it has to be implemented by that time. So that could be a challenge. So the sooner we get indications, hard indications, the better that is. But there's no question that the gravy train of high interchange is certainly going to be ending for debit. And the next worry is credit going to be the second and next target. On that uncontroversial note, I'll hand it over to you.
Thanks, Wayne. I'm not sure I agree with the never more interesting. I think that depends on where you sit. Sitting here looking at Margaret Reichert, thinking back in 2007, our roles were reversed. I was the consultant, she was the banker. She's a heck of a lot smarter than I am at this point in time. Tim, we're talking beforehand, and obviously consulting business is booming, right? Time of change, difficulty for a lot of financial institutions to work through this, and great time to be providing advice. So congrats, Margaret. I think you made the right choice in the end. I'd like to pick up on something Jane said a few minutes ago in terms of the resource issues. That's really, for me, I think where this discussion starts. Going back to November of last year, we, at least relative to my products and services, have been fairly well locked down in responding to the regulatory environment. We expect that to continue, obviously, with Durbin impacting next year, at least through the end of next year. So certainly that puts a damper on the innovation agenda that we had put together, and we're starting down the path of back in 2007, 2008. So while I do think over the long run there's an opportunity for more innovation, I think it truly is the long run. I think at least until 2012, you're looking at a lot of major financial institutions just responding to what the government is, telling them to do via either regulation, legislation, or both. Related to that, I think we're in a cycle of regulation and legislation, so there'll be lots of unintended consequences. I think we've seen some of those with the CARD Act, where credits become more expensive and more difficult to get. And as we start to see some of those from Reg E and from Durbin and other actions still to come, I think there'll be more fine-tuning and tweaking, which of course is going to lead to more work on the part of the banks to try to keep up with what the government tells us. And then the last point I would make here, before I think we turn it open to questions, is one around globalization. So to me, it's pretty interesting that Finovate has had its conferences in New York and or San Francisco for some number of years now, is just moving into having a show outside the U.S. They're actually going to have one in Europe here very near future. To me, because of the regulatory and legislative agenda, you're going to see a lot more current innovation and activity occurring outside the U.S. with institutions that aren't in the same boat. So, you know, speaking as a banker to a group of potential suppliers, I would be looking at not just the U.S. market, but also global opportunities, because I do think, at least for the next probably 18 months, that's going to be where a lot of the opportunity is to work with financial institutions to actually implement changes in products and services. It's going to be very difficult for us and B of A and Wells and others to get anything through other than the changes we need to make to our mainframe systems to be compliant with the regs and the laws. And on that bright note, I guess to turn it back to you, Tim.
Sure. Well, obviously, I think we're hearing some themes here. Lots of change, lots of uncertainty. And I think for many financial services provider, the loss of significant revenue streams from traditional banking products, whether that's credit card, the checking account business. And I think one of the questions I'd just throw out to the panel, perhaps to kick things off, is in terms of the innovation that you see that needs to happen in the industry to replace some of those revenue streams, where do you think the industry needs to start? And I would say for this group, what are the technological changes or new platforms that need to be developed to help financial institutions, financial services providers develop those new services? And Hugh, if you don't mind, I'll put you on the spot for that first one.
Sure, no problem. You know, again, for us, because we have a lot of our core systems are internal, they're homegrown, to the extent that we can find platforms or products or services that we can plug into our existing systems as opposed to something that we have to build or do deep integration, that obviously makes it much easier for us to get products to market. So, you know, you do see us working a fair amount with smaller technology companies in financial services to, you know, add on features or benefits for our clients. But, you know, your point on the revenue model, we sort of danced around it, but I mean, obviously we're a for-profit company. We've got a number of shareholders and stakeholders to take care of, regulatory being one, but ultimately investors in Wall Street being another. And whether it be versus, you know, other banks or other industries in the U.S. or even other banks globally, we've got to earn an appropriate rate of return on our capital, or, you know, there isn't going to be a SunTrust or, you know, fill in the blank. And I think that's one of the things that's getting lost a little bit in some of the regulatory discussions is we will find ways to go ahead and make up the revenue and, you know, change the composition of our portfolio such that we do earn the appropriate rate of return. And I think whether that comes from consumers or businesses, you'll see every institution from community bank and credit union on up to the top 10 going down the same path. So, you know, you can look in other markets that have been doing some of these changes, whether it be interchange or overdraft or others, and it, you know, changes the composition, but doesn't necessarily change the total size of the pie. And actually, Jamie Dimon a couple weeks ago was pretty adamant that he doesn't expect to lose a penny of revenue coming out of all the changes, that they will find a way to make that up. So, you know, one of the things that relates to the revenue picture is, you know, most of us in here are probably going to end up paying more for the services we have today, whether that be checking, you know, no longer being free, whether that be debit card, you know, no longer being free, or, you know, maybe even not being available for certain consumers or businesses, or, you know, things that we haven't thought of. So, you know, maybe we need to take another look at ACH, which, you know, today is essentially free exchange, and figure out how to adjust that. You know, whatever it takes, you know, we'll all be working down that path, and, you know, hopefully come out on the other end with a better picture. I'm not sure, though, that, you know, we're going to actually change the total pie. So as we've been looking the last couple weeks at other markets, it's interesting. The UK has had a lot of regulatory action over overdraft, as we have. And if you look at their revenue mix, they still have a very high weighting towards penalty fees, which would be, you know, definition of overdraft. So I'm not sure, you know, despite the best interests of various consumer groups, that ultimately, you know, what's been going on last year, this year, next year, is actually going to change the pie that comes from penalty fees, right? Maybe certain other fees go up as particular overdraft fees come down. Who knows? We'll have to see how it shakes out. But again, I would look for, total revenue to be, similar to where it is today in the end when the dust settles here.
If I could just add to that, so the companies that I spend the most time with are the electronic middlemen. And the theme that was already beginning to play out before the financial crisis and now is being emphasized is low-cost producer of whatever service these companies are offering. It is not an accident, and I don't think it's a coincidence, that so many companies are going through major platform changes concurrently, whether it's the effect of higher volume, increased complexity through globalization, or the worry and the concern of large competitors in the space that are trying to get smart and could have a flattening impact on prices that are delivered to the merchants. So that it's an overstatement, not every company, but many of the companies that I'm looking at, every conference call, there's always some commentary about technology investment and upgrade and to improve, to capitalize on the improvement, price to performance ratio, if you will, computational power, software capability, lower communication costs, and to be able to offer those services seamlessly around the world. That's a major and important theme, and it's easy for me to say, much more difficult to implement.
Thanks. Jane, I wonder if you would share some thoughts just in terms of innovation and the role of intermediaries, how you see some of the networks, whether it's the ACH networks or some of the other important payment systems networks responding and again, helping with this new cycle of innovation that we see necessary.
Yeah, I'll speak from the ACH network's perspective. I wouldn't want somebody to tell me I'm speaking for theirs, but I think one of the things that we're looking at is how do you utilize the network that's been built, that's ubiquitous to all the financial institutions in the country, and how do you leverage that to, I think, use it to its fullest capabilities. So, for instance, with what Fed Global's done with bringing in payments now from Equins in Europe. So we created the IAT. It's an international transaction format that was, I think, with a great deal of pain and suffering from the industry. But now we have a format that carries all the travel rule information so you can actually map it to an ISO 20022 standard and bring it to Europe and bring it back. So I think it's starting to say, look, globalization is a reality. How do we start leveraging and so you don't have to have a corresponding banking network all over the country, or if you're a financial institution that is not huge and you need to have those relationships, you can leverage the international payments framework that has been created so you can map transactions into other countries. So I think that's one. I think one of the other regulations that we haven't really talked about is the health reform, because this is financial services, but I think it's really interesting for us to start spending some time thinking about the opportunities in healthcare, because in the healthcare legislation there was an EFT mandate within the healthcare legislation, and it's really saying we want payments to start being moving electronically. And one of the biggest needs there is not only the payment, but it's payments plus information. So how do you move a great deal of data securely? If you want to add the payment plus the information, today they have to be reassociated manually, and it is it's heavily paper, the process. So you may send out a check, and then you send out the remittances, and you have to put those two things together. So something that we're looking at is how would you leverage the ACH, which has the capability of moving a great deal of data along with a payment, but how do you do that securely, privately? So that's something that we're looking at. And I think the other thing is, one of the things that Hugh said that made me start thinking is, we've been looking at P2P payments. And part of that discussion is, from your perspective, when you're looking at revenue, maybe the mindset of free for everybody, everything. I mean, that was one of the things I think hurt innovation a little bit, because both financial institutions and their providers knew we have to be able to support this out to, all of our customers free, and we can't really charge for it. Well, now maybe if that mindset changes to say it's not only not free checking anymore, but if you want a P2P payment getting there today, same day, are we going to charge for it? Is that worth something? Is there value to it? Or tomorrow, or next, more the FedEx model, is it, overnight or next day? So is that mindset going to change so that you can actually create a business case that doesn't presuppose that you're not ever going to get any income coming back in from it. I think that that may change and have a good effect on innovation. So I think there's at least 3 areas where there's a lot of really interesting things happening that have a lot of opportunity.
Great. Well, a lot of good opening thoughts there. At this point, I think we'd just open up the room for questions from the audience. Yes?
Jane, I have a question for you. Will you talk a little bit about the secure vault payments, the role you think it will play? What is it? Why does it exist? And will the regulatory environment hurt or hinder its adoption?
I'd love to talk about secure vault payments. That is a project that NACHA has been working on since, I think, 1997. And just last week, I think Tuesday or Wednesday, a press release came out announcing that U.S. Bank is going to be offering secure vault payments. And it's come out of its pilot and really shown a strength and a niche for both the college and university space and for nonprofit space. So what secure vault payments is, it is where you go into a merchant or a biller's website, a consumer would go to make a payment, and they are rerouted to their financial institution where they push a credit payment out of their financial institution to make a payment to that biller or that merchant. And I think from a merchant perspective, the value in that is they're getting a credit payment. So it's for a good funds model payment coming, but they also don't have to keep the data. They don't have to keep whether it's my DDA and routing number, they don't have to keep that data secure themselves. So what they're getting is a real-time, it's an authorization message, and then the payment actually flows through the ACH network. So the payment is not real-time, it's just the auth is real-time. And so we're now into production, and what we're watching to see, this college and university space is where we've seen some of the best pickup. And the University of Georgia was one of our first pilot participants, and they worked with Synovus Bank, who are big innovators in the space. So I think we're watching that. I also think it can change the dynamics for financial institutions, again, both from a business method for both of them, looking at both sides of the financial institution. I think that there is a business case for both sides of that, and not just your normal ACH payment, because there's value that's getting sent with that. So I think that in this space, in this dynamic, there's big potential for SVP.
Other questions?
I don't know if anybody's going to want to respond to this question, but Steve made me think of that with Jamie Dimon's comment about making up all the money that's lost. And I wonder if you have any thoughts on the TCF financial lawsuit. And Jamie, I'd love your thoughts on that as well. Anyway.
Well, the interesting thing to me out of that, which is similar to what B of A has said, is both B of A and TCF.
Yeah, sorry, just let me repeat the question quickly. The question is, any viewpoints on the TCF financial lawsuit and what the outcomes might be?
Both B of A and TCF have come out and publicly said that they're anticipating between 80 and 95% reduction in their debit interchange income. I think it was Wayne that said, his companies he covers are looking at lowering their costs. They need to be, right? If we're going to suffer that kind of revenue loss, rewards are going to go away. Fraud needs to go to zero, which it presents some interesting challenges perhaps for the merchant community. Do they need to invest in chip and pin? Do they take the liability on transactions that go bad? To Jane's point, regardless of what the level of interchange reduction is, I think there's huge opportunity for online purchases, particularly by consumers. Again, that's a high fraud area, as many folks in this room know. It's potentially a channel that people are going to have difficulty using debit card if interchange is reduced significantly enough. So what steps in to fill that void? Is it secure vault or other payment mechanisms or a combination? We're obviously watching the lawsuit with interest. I'm not a lawyer, so I can't comment on the specifics of it. I mean, as a layperson, it seems hard to see how it would be successful, but certainly understand the rationale for challenging it. Like most other banks, we're watching and waiting to see what the Fed comes out with. It's my understanding that there's only been one major bank that's really had any great deal of conversation with the Fed. It's clearly not us. So, we'll watch the lawsuit, we'll watch, the Fed and respond, accordingly. It's actually part of why we've waited to make any of the changes to our checking solution. We don't feel that it's good to, hit consumers, quarter after quarter after quarter with a bunch of changes. We'd rather understand what the landscape's going to look like for next year and the year after, and then roll out whatever we're going to roll out at the time. So, we'll see. We've got some lawyers in the room. They may want to comment on the chances for success there.
Well, I think even not getting to the merits, to me, it's process. So sometimes it's, if you can't throw substance, you'll also try to mess up the process or attack process. But I think that the interesting thing about the lawsuit is, unless there's a preliminary injunction, the timing can't stop what's happening. So unless there is an injunction, unless they're enjoined from going further, by the time it's heard, it could be, this could all be rolled out. So financial institutions have to be you have to be acting as if it's not out there and it doesn't have any chance of success, but just because you have to be prepared when it does happen. And one of the things that reminds me of Reg GG, so the gambling regulation, we knew that everybody in Congress, that there was big forces in Congress that wanted to repeal that part of the Safe Ports Act, which was the prohibition on internet gambling. And we knew that they were moving, but the timing just never happened. And up until the day that the reg was enacted, everybody thought that it'd be pulled back. And then a little bit later, they said, well, the timing was just off on that. So I think with TCF, the same thing, which even if it is ultimately successful, I don't think it's going to be successful until too late for everybody who has to really get their systems up and running. It's just so.
You just kind of piggyback on one of the things you said. You talk about the fact that you're going to have to find a way to raise fees across the board and keep the pie the same size. How does a bank balance that with the rise in alternative means of ways that financial services are delivered to folks, either through a store value card to retailers like a Walmart? What's going on at SunTrust, or what do you see playing out in the industry as a way to combat that rise in alternative channel?
Well, I don't think it'll be fees across the board, right? So we have, certain customer segments that, regardless of current pending regulation and/or legislation, are still going to be very profitable for us. So what you're really talking about, to be perfectly clear, is probably a low to moderate income segment that, frankly, has come back into the banking system, if anything, over the past several years, that potentially might be driven out to other means, whether that be prepaid cards, payday lenders, or other financial services providers. So without being too specific, we're prepared for that. We certainly have a fair number of those clients that bank with us. We are a mass market bank. We deal with consumers across our footprint from all income spectrums. And we're ready to, we think, come out with some interesting product opportunities. But again, our challenge is trying to get those in while dealing with the legislation and regulation. So we may have the timing issue that Jane was referencing, in that, we're going to see some short-term revenue decline before it gets built back up from new products and services. But I don't think it's necessarily the same mix of services we have today or other large banks have today that's going to win with that segment. And you are correct in that as we and others move away from free checking and institute fees for certain products and services, some consumers will look for other opportunities. I would caution, though, that our research shows that most of those other providers actually cost more than we do. There's lots of kind of personal historical reasons of why a consumer would choose to do business with a bank or not. They're a lot less about the fees that they pay. And to me, that's one of the fascinating things about this period of legislation and regulation is, a lot of what's said publicly, rationale for doing things, actually turns out not to be true. There was a lot of hue and cry over overdraft and all the changes we've made, and it turns out that a fairly large percentage of consumers have actually opted in, right? So now all the public interest groups are complaining to the OCC and the Fed and others about, surely the banks did something wrong. Well, our own customer research said that those customers would opt in because they knew they needed the money, right? And this was a lower cost source than going to a payday lender or some of the other providers. And so, we think there are some elements of what we do today that will, stay and that consumers actually like and value and are willing to pay for, and trying to maintain those while we, manage through this turbulent time is going to be a challenge. But, we do think that there's opportunity for banks, partly because of the convenience of the networks. Mobile's taking off. Obviously, online's come a long way the last 10 years, but ultimately people still want to deal with a person, and typically face-to-face when there's a problem. So we think that gives us an advantage relative to, some of the other options out there. So, we're not pessimistic long-term. We think long-term there's actually going to be more opportunities for us in terms of not just general innovation, but specific customer segments. It's just the challenge of getting through where we are today, getting through the regulatory pipeline and coming out on the other end. Not sure how that timing's going to line up yet.
Wayne, can you talk about there's been a lot of talk about how the issuer is going to get impacted by the reduction in interchange. Can you talk about what your feeling is on the impact on margins for the acquiring side? And then also, with the acquirers, how they'll play out with merchants they have priced at, interchange pass-through versus bundle pricing. And then lastly, the impact on the acquirers from the perspective of putting in the technology to be able to switch those transactions, which is really not in place today. Can you kind of give us your perspective from the acquiring side?
You want to repeat it?
Sure. The question is for perspective on how the regulations will impact the merchant side. I think the pricing models for merchant acquiring, whether you're a merchant that may be on bundle pricing or unbundled pricing.
So, so just to back up a little bit, in my mind, about if I take the total merchant discount fee as a pie of cost, total cost to the retailer, approximately 75% of that expense is card issuer related, and that's what the Durbin Amendment is trying to address. I'm not commenting on whether that's right or wrong. It's just a kind of a statistical fact. Then that leaves essentially, and these are rough numbers, right? So this is not an exact response here, but roughly speaking, 12.5% of the remaining expense is for merchant acquirers, and another 12.5% to the card, or not the card networks, but the card associations. So in reality, that merchant acquiring expense is probably a little higher. Card association expense is a little bit lower. As far as how this plays out to the acquirers themselves, interchange has been a pass-through to date. So in theory, what the merchant acquirers would do when interchange was going up is they would ride on top of that wave and increase their merchant acquiring rates by a couple of basis points. So inflation actually benefited them in that way. Also, in theory, on the way down, they will or could potentially lower their total rates that they charge to the retailers by a less amount than what the percentage decline is for the interchange. So they're trying to play the spread, so to speak. So if that's allowed, and my limited understanding of where, because it's cloudy to me still, of how the Durbin Amendment is really going to play out and how much the Fed is really going to tighten the screws on all the other players around that in the process, then they should, in the middle market and the lower end of the market, they should be okay. They're not making any money on the high end, right? 50% of all transactions are really tier one, and they're already 5-6 basis points kind of per transaction. So what we're really talking about is the SME market. And in that market, how are the merchant acquirers going to be impacted? In theory, they shouldn't directly be impacted that much. I don't know if that answers your first part of your three-part question, but that's the way I'm kind of looking at it. I think the other part of it was related to the card associations. Here, it's more fuzzy than the cloudy answer that I already provided, because in theory, it's passed through for them too. But the difference is they had an influence on that 75%, whereas the merchant acquirers did not. So if the card associations were part of that decision-making process then in receiving revenues, the interchange is not recorded for the card associations, but they have something called assessment revenues. So if I'm a bank and I'm making 50%, I'm just making this up, make the math easy, 50% less today on the same debit card transaction that I was yesterday, I'm probably going to have a discussion with the card associations about what those assessment fees should be. And if that's the case, then isn't there going to be a collateral damage? Aren't they going to be impacted? So that part is possible. In theory, just to be clear here in my unclear answer, in theory, as we understand it today, it's all passed through, right? In theory, neither the acquirer nor the association should directly be impacted. In reality, I think it's going to be more the card association on the back end, and there may be ways for them to make that up, if that helps at all. So I mean, I'm not going to quantify it on a per company basis, but both MasterCard and Visa have come out and said approximately 15% of their 15 to 20% of their business, could be impacted by the Durbin Amendment. And I'll leave it at that.
So there's a lot of new models coming out, or a lot of models around data analytics, financial transactions, and what you may be able to do with those, and how you might be able to give offers to consumers, or also, provide more insights to various players on what the consumers are doing. How do you think the regulatory environment is going to, proceed over the next few years in privacy areas?
So the question is, with the need for new analytics to drive product innovation, how do we think regulators might act over the next few years in terms of regulating privacy?
Was that directed at me? Everyone's looking at me. Okay.
Go ahead, I'll follow up.
Oh.
Please.
I'm going to defer to Jane on that. Security is a exponentially growing problem on the internet, and for obvious reasons. And I don't know how the problem, maybe one of your companies has a solution, but I don't know how someone's going to, quote, guarantee that information is safe when it's accessed by the internet. Tokenization, SSL, public key infrastructure, all that other stuff notwithstanding. But I gotta believe that knowing more about your customer is better than not, and being able to have a reasonably safe place to put it is going to make consumers feel much more confident. Financial institutions have been one of those places. So with electronic bill presentment and payment, consumers on one of them felt comfortable setting that up through their bank. So banks may continue to play a role in that. They already have much of that information, and they're already security conscious, as they are the guardians, not just of our finances, but that information too. So I would think that's where some of these plug-and-play services may originate from over time.
It's interesting. I think that, so looking at from both the consumer side and then a small and mid-sized business side, on the consumer side, I think one of the things that as we think about privacy and data security, we tend to forget that checking account information that somebody has on a check is everywhere. I'm handing my check across the aisle, I'm sending a bill, with it in the mail. So it's interesting because we think about PCI on the card side, and then ACH, what I call ACH data, which is really just DDA information, and it's a very different dynamic because that check is there. And so if you totally locked that down, what does that mean and what does that do? And back in the day, a long time ago, it seems like now, I was a branch manager before I went back to grad school of a bank. And I watched these people come in who had their mailboxes raided and their Social Security checks pulled. And you think about that, and one of the best things you can do, and what the Association for Financial Professionals still says is one of the best things you can do to manage fraud and to protect data is stop writing a check. So I think that that's kind of one of the things I'll just say to put it out there is that DDA information is it's omnipresent. But I think on the small and mid-sized business side, there is a lot of opportunity for risk analytics, both for financial institutions and for businesses as well. So when we look at something we've been calling corporate account takeover, it's where you have a computer intrusion and there's a Trojan horse or the Zeus placed, key logging malware that's infected into a business's computer, and then they take the computer and then they can actually use the credentials the financial institution has set up to gain access to treasury management sites. I think it's a complex issue because the first thing we need to do is get the same kind of effort that's been done on the consumer side to say, protect your financial security. This is what identity theft looks like. This is what you need to do. That kind of education has to be done on a small and mid-sized business side. It's really a partnership. It has to be things like, hey, don't use the computer that you're sending payroll out at the Starbucks in a Wi-Fi hotspot. There's some of this education that really, it's scary when you find out how computers have been compromised, what folks do. So I think on the business side, there's a lot of education, not just worked with the Better Business Bureau, Data Security Made Simple to try to start explaining kind of common sense precautions. Some of the old school things that we think about, like dual control. I mean, those are still some of the best ways that you can mitigate your risk is having a payment under dual control. So I think that's part of it. Then on the financial institution side, it's really doing more analytics on the payments that are going out, and whether it's ex post or not, it's taking a look at what's going on. Is this an anomalous payment? What's happening with this? Have 55 new payees just been added yesterday to a payroll file? So I think that there is, 5 years ago, there weren't really any tools in this space. And more I'm hearing of different solutions coming out and a lot more activity in this space, both from looking at analytics of the payments themselves, but also solutions, Trustier for locking down the pipe or Iron Key for to lock down the session. So I think that both are new things coming out, and there's a lot more that can be done to help secure that. But it's really, I think, a partnership between the financial institutions and the businesses. And when we talk about regulation and the potential for that, Senator Schumer had introduced a bill expanding Reg E to school districts and municipalities because of some of the issues they have with the corporate account takeover. So I think that's something we need to look at with the change in Congress. That might not go anywhere, but there are risks. There's a lot in the newspaper about how small businesses are not protected and they don't have the Reg E protections. And so I think that we really have to be working on what those tools are and what that relationship is to make sure that A, businesses are informed, and B, that financial institutions have some tools and some more tools to help them as well.
Any other questions from the audience at the moment? Yes, Glenn.
The point you made the point earlier that it's low to moderate income consumer that's most likely to be crowded out of the bank channel because of the new regulations. Any thoughts on what that might speak to as far as potential innovation? Is it more likely that those consumers are more likely to go to the existing solutions along the lines of payday lenders, stored value cards, or does that say something about where innovation might have a key opportunity?
So the question is, with the impact on the low to moderate income consumers, what could we expect in terms of innovation for those segments?
So my own opinion is that's a great area for innovation opportunity. I don't think they're necessarily going to go to some of the providers that are already out there. If you look at, for example, brand strength among low to moderate income consumers, Walmart scores, I think, 3 or 4 times higher than B of A or Citi in terms of trust and brand recognition. So, I certainly wouldn't consider Walmart a traditional financial services provider. I know they've desired to be one for a while, and they're fairly close now. That'd be an example of, I think, the kind of opportunity that's out there, and as well as, new products and services. So prepaid, or potentially taking some of the existing services that may be done at a check casher or a payday lender and finding a way to make those lower cost and done, in a bank or bank-like environment would be another area of opportunity to serve that group. And again, you may not make a ton of money on an individual transaction or relationship, but because of the large numbers, it's a pretty sizable market and can be done profitably. I forget the exact stats, but I think something like half the population of the U.S. makes less than $50,000 a year. I think the average income is right around $43,000-$45,000 for a household. So, you're talking about tens of millions of households or consumers that are the bucket for opportunity. Again, they may not have a ton of disposable income, but they are paying fees today. They're paying lots of them to different providers. And if you can come in with a little bit lower cost solution that provides as much as or maybe more value, I think there's tremendous opportunity there. Again, not to diminish the kind of mass affluent upscale opportunity. I think that's there as well. But as we were touching on a little while ago, I think some of that is around person-to-person and online purchases, some activities that occur today that maybe don't have well-defined or robust solutions providers, and may have some gaps opened up based on diminished credit card availability or debit card costs for consumers and the like, that sort of create a churn and an opportunity. So opportunities across the spectrum from a consumer standpoint, but I do think there's significant opportunity in that low to moderate income segment.
I have a question, perhaps Wayne could address it. And the question is about the effect of the regulations on the growth of the mobile payments industry. You talked about winners and losers. Is it a constraint or is it an opportunity for them? So to repeat the question, will regulation have a positive or negative impact on the evolution and growth of mobile payments? Mobile payments, particularly in the U.S., is really in its infancy. So I would categorize that as a new market creator. And new markets tend to grow through, in the very early stages, when they don't have mass, tend to grow through their environment regardless of what it is, whether it's positive or negative economically speaking. I think that it's going to happen, in a big way over time. So I guess my answer is that I don't think it's going to have much of an impact in the near term. About 25% of all cell phones in the U.S. are smartphones. So there's 275 million total phones, and 25% of that are smartphones domestically. Globally, there's 4 to 4.5 billion cell phones. Of those, 6% are smartphones. So the next generation of smartphones that's coming out, and they're coming out fast and furiously, are going to be a stimulus for mobile payment adoption. So recently I saw an ad that Walmart was offering $40 a month for a smartphone. And then I saw one that Metro PCS was offering $40 a month. A couple of weeks ago, Home Depot launched a mobile commerce site. They expect 50% of their business domestically to be mobile commerce in 5 years. Now, that's a special case because most people don't go to Home Depot to browse, right? They tend to know what they want when they go there. But then on the other end of the spectrum, you have Chipotle, where I can order my lunch beforehand and pay for it and pick it up. So you have opposite ends of the pricing spectrum. Everyone's getting into it. So I see it more as a consumer convenience rather than being positively or negatively influenced by regulation, because I believe the payment choices are going to continue to evolve. Am I going to have it attached to a credit card? Am I going to have it at some point attached to a checking account directly?
Oh, okay. So I'm sure this would have sounded better the first time, spontaneously. So if it's not as good, bear with me. But I think one of the unanswered questions is this Consumer Financial Protection Bureau. And today, the Division of Consumer and Community Affairs of the Federal Reserve Board is the department or the entity within the Fed that deals with consumer protection. So they have TILA and they have the EFTA. And when they are looking at regulations that have the potential to impact the payment system, they work very closely with it's the Reserve Bank Operations and Payment Systems, the RBOPs of the Federal Reserve Board, and those folks know payments. They understand the payment system. They understand how the ACH works differently than the debit card system, differently than the credit card system, and there's a very close relationship there. So if, say, the Regi people came up with something that might be fabulous, but it would entail, some kind of real-time interception of payments, they understand that the ACH is a batch payment system, for instance. That's just an example. So with the Consumer Financial Protection Bureau, one of at least my concerns as I look at it is a loss of payment system expertise, a loss of understanding how things work. So if you have a mobile payment that is layered on top of the ACH or credit card or debit card, having an understanding of how the underlying payment systems work is really important. Now, the CFPB might be taken, a lot of the folks from the Division of Consumer and Community Affairs might be going over to that bureau, but over time, not having, I think, the input or the understanding by people who really understand how payment systems work is a risk for all of us, because then you have regulations that come that may not have an understanding of what that really would do when you have millions or hundreds of millions of transactions flowing every day. The way you can't do those things. So I think one of in this time of uncertainty, one of the things I think about is all these regs. They aren't even being rolled out yet. They're just starting. So for a period of years now, 2 or 3 years, we're going to be seeing this rollout. And with the CFPB, their mandate is very, very broad, and there's very little oversight over them. There's just kind of the big veto power from the FSOC. So there's just very little to really to stop if something's going very awry. So watching that, I think we're not going to know the impact about how they're going to be dealing with things for a few years yet. So that's something that for mobile payments or for any innovation, I think the board today was very much, let's not regulate on top of technology or innovation. Let's see how it plays out. Maybe not as much as everybody would want them to, but they really did step back a little bit on some things to see how things rolled out. They did it with prepaid, they waited. They did it, they're doing it with mobile, they've waited. But how the CFPB does it, if they're more regulate first, and then let the winners win in the marketplace, that could really change the dynamic. So I think that there is that question mark.
Great. Well, I think we have time for maybe 1 or 2 more questions. Yes?
I was wondering about the impact of the provision for a small community financial institution, the $10 billion rule, what the impact is likely to be on the larger banks, what the cost is on the $10 billion rule.
The question is, with the potential for revision of the under $10 billion rule for the application of the Durbin Interchange amendment to smaller banks, what the conversation is about that at the moment, what the implications might be of a rollback of that rule?
Well, I wouldn't normally speak for smaller institutions, but we did just interview somebody from my team about a week ago that works at a less than $10 billion institution. I can tell you that they are actually assuming they will be impacted in the same way from Durbin as we and every other large bank. And in my mind, that's a pretty reasonable assumption. In our conversations with some of the networks and card brands, the legislation sounded great probably when it was written, but practically speaking, it's not how the payment systems were intended to work, particularly on what could be as short as 90 days, 120 days notice of, what to do before the deadline. So if I were a community banker, I'd be assuming that, my revenue was going to be hit probably just as proportionally large as every other bank in the country and be acting accordingly. Maybe there'll be a way to mitigate that. Hard to say for sure, but I'm pretty skeptical at this point in time from the conversations that I've been part of that actually will happen, practically speaking. Now, again, if we wanted to take a longer term view, sure, in a couple of years, there's probably a way to make that happen fairly easily. But again, trying to make these large, hardened payment systems work in ways they weren't designed to do on very short notice, really not all that feasible from the real world perspective.
And even if it was, I think from a community bank perspective, what I've heard also is a fear that that retailers would be routing payments away from the smaller financial institutions where they'd be paying more. So I think that there's a fear that one way or the other, whether it's not being able to route, to be able to actually physically do it, or that you're getting different treatment or disparate treatment because that you're a smaller financial institution from merchants. I think that there's a fear that one way or the other, the impact will hit everybody equally.
Any other questions? All right. Well, thanks again for everyone joining us this morning, and thanks so much for the panelists. If you join me in a